Hey everybody, this is Paul doing a video on July 28th. It's currently 12:34 Central Time and the market is currently open. I decided to do a video since it's close enough to the end of the month that it's kind of there's no new real data coming out that's going to really affect too many things. Um, but I figure, 31st is here, 1st is there. It's kind of close enough that I can get a general idea and go over a video here. Um, So, I guess let's go over what's going on in the market so far this month and just kind of my thoughts on it. And just kind of trying to get people out of this weird bear narrative that's going on. It's so weird because it's people that think that the market is just going to go down just continually can keep being wrong, and you just have to kind of look at it to try and figure out what's going on. So I'll explain what's going on here, I guess, as best as I can. So far for the month, as it stands right about now, I'm up $2,562, 4.2%. As it stands since the beginning of the year right here, that's 28%. A lot of that is from me contributing my own money, just so you understand. And and you're going to notice also there's a big, massive difference in the yearly dividend. I'll explain where that's coming from also. Um, so if you don't follow me on Twitter, of course. And so basically what's going on is my chart that I have down here has my different targets on it. So what I've started to notice is the market is trying to obviously break out to the upside, as you can obviously see. If you go to the 1 year, obviously you see I was trying to break out to the upside. I was trying to get out of this bear market that we were in, and we're trying to enter into a new bull market with rates this high, which is very strange to say. So what I've noticed is I'm trying to lock in the lowest prices possible now, um, as I know prices are probably going to be higher possibly a year from now, possibly, as inflation should have definitely moderated by that point. If not, we have bigger problems. So the hope is that by next year the Fed will be talking about rate cuts versus rate increases. We need to get out of this phase. That's if the economy's strong and all that good stuff. So what I noticed was is that on these different targets, BSTZ for example, HYG, O, is I was very close to hitting some of these different targets. So like say the goal is 150, I'm 93,000 away from that, and then I was very close to hitting like say BSTZ. So I said to myself, well, why don't I just take out, because I believe SPHD is going to probably trade flat for quite a while. If you look at my last video, I think there was about 25,000 in there. So I think SPHD is going to trade flat because a lot of those companies rely on lower rates to hit new highs, and that's just not happening anytime soon, as you can obviously see here, because they have to take out debt. That's how they expand their operations. They're more exposed to the different debt markets. So what I decided to do is pull back on SPHD right here, and I also pulled some out of AFB. And what I decided to do is just start knocking out these targets that are very close to where I want them to be. So right there, for example, right there, I also put a lot into BST because if tech breaks out to the upside, then BST can run. So if we go down here, so if we scroll all the way down, you'll see I made this large purchase right here, so 5,000, 148 shares, and it's already up 28, 0.5%, and you can see the rest of them here. So if tech breaks out to the upside and breaks out from its, prior lows and, starts running towards 16,000, which seems kind of possible given the earnings that just came out, and you can kind of see here. Now this requires lower rates to really break out, which you need the inflation reports to keep coming out, or keep going down, or else this will reverse on you. So what I decided to do is to try and start hitting these targets. Now what happens after I hit these targets is I turn off dividend reinvesting because I've hit the targets. So right now I have $113 worth of dividends a month that are not being reinvested. So what I'm going to do with those dividends is contribute them up here. And then once I hit my target on BST, which will be the next one, as you can see right there, that'll end up being $220 per month. That'll go into my cash account, and then I will use that right there. And then once I hit AFB, pile money in the AFB, and then once I hit AFB, that will end up being $371 worth of income that will get piled into SPHD. And then that'll be, and then once I hit my 150, that's when I'll decide. I'll probably just do something literally like this. I'll probably literally just do that and start all over. But by that point, it'll be 622 coming in, and my new goal would end up being, see right there. So you can kind of see. But in the meantime, while all of that's going on, in the background, the dividends are actually going up. So, like for example, SPHD went up by, like, say, I think it went from 0.155 to 0.158. And as the underlying stocks in these ETFs increase their dividends, which is happening over time still, because they invest in stocks that do that. That's the whole point of this. Is the underlying ETF, or is the ETF that holds them, will increase their dividends also. So the dividend will go up. So the dividend went from like 617 to 622 without me doing anything. So that's all passively happening. And then obviously everything that's not green is being reinvested. So this is being reinvested each month into these up here. So let's look at the data. So obviously the Fed hiked. There's so many charts we can pull up. I end up having so many of these things that I don't go over. Yeah, we just have so many charts that we go over. So there's just different charts that are showing weaknesses in the economy. The amount of people applying for loans versus being accepted has obviously spiked. So the application rate is right here. The rejection rate is right here. So these two lines have crossed each other. That's typically a bearish symbol. That means banks are restricting credit. For people that are saying the Fed needs to hike faster, just to give you a general idea, you have to break it down by percent, where they started from where they're going to. So if you break it down by percent, as you can obviously see, we're in the fastest Fed rating hiking cycle in history. Just to give you an example, you can kind of see here. We have Northern Trader Savin on Twitter obviously has this line going all the way back to 1988, and the market has been pretty predictable on riding that line. So it looks like we might kind of ride that line, and if we ride this line, we'll go above it, come back down. But we've been kind of since 88, and that's when taxes started getting. I'm guarantee you can extend it right back to here. If you want to really extend this line back, it could bring back here. That's when tax rates started hitting this new thing. That's when corporations started buying back their shares. There's just so many things that affect that. It's just the 80s revolution in stocks. Post 80s on, this is what you get, that line right there. If you had tax rates still in like the 60% range, I can imagine this line would be much lower right now. And we wouldn't be such a market-focused economy. So this is the, let's see, I don't even know what that is. Close that one. Let's see what we got here. Yeah, here you go. So this is what pretty much everybody knows right now. If you get a reacceleration in inflation, then it has something to do with rent or shelter. That's simple. That's where we're at. Everything else you can see is literally making up almost nothing of inflation right now. Rent coming down is going to be what decides if we go into a recession or not. That's the only thing that matters. As you can obviously see, it's just a massive. This is back when we had stimulus checks still in there, and we were just getting massive spending everywhere else. Inflation was going up. Oil prices were going up because of the war. But you can look now, and it's very clear that it's just rent. Rent is the thing. Now, what's affecting that is basically this. This is the biggest thing. This is a chart. You can pause here to look at this. But people are just stuck. They can't go anywhere. The housing things. Yeah, so this is like, it's just people are stuck. This is kind of what's going on. So so what's going on is nobody wants to go from a 2% mortgage or a 3% mortgage up to a 7, possibly going to 8 at some point. And that's 7% is if you got great credit and you put a 20% down payment also, by the way. So nobody wants to move if you're in a great place. So people are just paying down their stuff. They're sitting on fixed rate mortgages. They have nowhere else to spend their money, so they're spending money on services. Um, because if you move and you go from 3% to 7%, then you effectively just doubled the amount of money you're putting out every month. Nobody wants to do that. So yeah, you're probably noticing actually as you're driving around, you'll see some for sale signs, but you're not seeing nearly as many as you were when this all started. What you are seeing is that every little empty lot in your neighborhood is getting bought up with a new house put down because it's actually cheaper to build a brand new house than it is to actually move, which is crazy. There's probably 5 separate projects alone in my neighborhood that are being built from the ground up. So I found that pretty interesting. And then this is very interesting. Um, so this is where we run into problems the longer higher like rates stay higher. So this is where the problems start to occur. And I've shown this chart before. If you go to any bond trading desk, no matter what you have, where you can buy bonds straight out yourself instead of buying them through a mutual fund or whatever, you see all these different rates on all these different bonds and whatever out the 5 year, 10 year kind of thing. This is where corporations like to refinance at. Interest paid on debt by corporations, interest paid on debt, as you can see, is actually quite low because every corporation in this country was smart and refinanced right in here when rates were very, very low. Now they refinanced out to 2025 and 2026, and that's where that wall is. If we're still at these rates around 2025 and 2026, you're going to see mass layoffs. Just for the simple fact that corporations are going to have to like issue debt at astronomically higher rates. I think if I went into my folders, I could probably find you what this looked like. But this stuff was saying 2% previously, like 2%. Like it was almost nothing here. Like these were nothing. Like CD issues, like this was all like 0 point something percent. Like these were all like hyper low, and that's completely changed over time. So that's where the higher for longer thing will really cause a one. It's 100% will call a recession. So this is something that Andy Constan puts together on Twitter every once in a while, and this just gives you a general idea of what the ranges are for this market. If we go into a recession, you go sub 3,500. That's their general thinking. The 10-year note would drop to these different ranges. If the 10-year note goes this higher, they're thinking that we stay in these ranges here. And if everything works out perfectly fine and we don't have some massive thing blow up, this is called soft landing island or no landing island at this point. There's more likely no landings over here, higher than where we were, and we stay in this range. It seems the market has hit a new wall around 4,600. That's going to take, lower rates maybe to get past. This is kind of interesting. China's actually got deflation going on. They have just massive issues in China that we're not having. We do have, this obvious problem here. This was the cover of the New Yorker right here. As you can see, we have obvious problems in commercial real estate. I did an entire video on where I think one of the major problems is. So there's things out there that could bring this economy into like a crash. Now, will the Fed let it blow up? And the reason why I say that is because in March, they could have let the regional bank system blow up. They could have. This is what they would have done in 2008. In 2008, they would have sat back and let Silicon Valley Bank go bankrupt. They would have let First Republic go bankrupt. They would have pretty much did what they did in the 80s. They would have just let them all go bankrupt and then have to bail them out afterwards once they needed to cover their insurance or their insurance deposits. That was the whole 250,000 debate everybody was having in March. That was your credit crisis for 2023. If they had let the banks go bankrupt, we're in a recession right now. If they just start letting banks go bankrupt and not merging them or bailing them out or doing whatever, you have a flat out recession right now because no regional bank in their right mind would lend money. That's just what goes on. And that's just what happens. They would all stop lending money, every project would come to a halt, everybody would put down their stuff and go home. And then you would have mass layoffs. You would have your typical recession. But that was your 23 chance to have your recession right there. So, but the biggest thing that's still sitting out there is going to continue to be corporate real estate because these guys are on much shorter loans, and they're having to restone or refinance or sell these properties and just get rid of these properties. But these are popping up all over the place. You can see it right here. So that's where we're at there. So that's one thing. This is the Fed statement. If you want to pause and see what kind of changed, nothing really changed. Q2 GDP came in pretty high. That was the Atlanta Fed had this perfectly fine. They have a tracker that they use. I suggest you follow the Atlanta Fed Twitter account as they release this, as it's updated. Currently for Q3, they're saying 3.5%, which would be pretty amazing. And they're expecting consumer spending to be a massive part of that, even bigger than Q3 of 2022, which I question if that's going to be right, but that gets adjusted a lot. And then the conference board leading indicators continue to show that we should basically be in a recession right now, but we're not. Nobody can explain this. Literally nobody can explain this right now. And I think the only explanation is that we should be in a recession if everybody was sitting at like a 7% mortgage rate. And if businesses had to refinance at 5.25% interest rates. If businesses had to refinance right now and if everybody in their house was sitting at a 7% interest rate, you're 100% this is accurate. That's the only thing that's making this completely inaccurate. And then also, if they had just let the banks fail, this comes through. And I think they have to be looking at that, but so this is where we're at. So this was a very interesting chart showing the different retracement levels during different bear markets, like what they look like and how long they took to get out of them. As it currently stands, I believe we're sitting at 70%, 70%, 76% retracement. So that's very interesting. And then also, here's a different thing. Here's the stuck in place kind of deal. As you can see, new listings are much lower than any other year previously, going back to 2018 or 2017. So you can see new listings are basically just crashing down. And then seasonally, they just crash down. And actually, in 2022, they went down. But I think in 2023, rates even higher than they were in 2022. This is actually going to be pretty scary for like as you go into like the winter months. Nobody wants to buy a house. New listings are going to go like that. The U.S. housing market is in a slow process of effectively shutting down, which is very weird to see without a recession. But so that's where we're currently at, and this is also something very interesting that I posted here. As you can see, these were the moves that I made in the portfolio. So you see just different things that I did and move money around to kind of increase my dividend yield and catch the upside on the tech market. But that's currently where we're at. Um, I don't. I'll be surprised myself if the market breaks above 4,600 anytime soon. That because if we don't have a Fed meeting in August and the next one's in September, the only way that we break above 4,600, I believe, is if we get another surprise inflation report that's much lower, much lower. While all these numbers are still good, jobs numbers are still good. So if all these other numbers are still good and we get a surprise inflation report that's still down, the market's going to do what you're seeing today. The core PCE or core PCE deflator or core PCE came in today much lower. They were expecting to be 4.5. It came in at 4.1. You get another one of those reports, we break above 4,600. Right now, 4,600 feels kind of like a ceiling for this market where we're going to do that thing where we bounce around for 3 months again, which I'm fine with because it gives me time to build up my portfolio at these prices, especially that because once rates start getting cut, this is going up because people are going to start looking for higher yielding and then also non-taxable type things, which is muni. So this will go up if rates start to get cut. So that's kind of where we're at right now. Let me know what you think in the comment section, and then we're just kind of going from there. Just kind of like I said, it's just kind of waiting on data. So thanks for watching, y'all.